This video is going to be an overview of the internal controls over the last three business processes that we're going to talk about. And that's going to be plant, property, and equipment, inventory, and investments. We hit these particular internal controls at a fairly high level because these transaction cycles typically are not tested as much as basically purchases payable, sales receivables, and to a lesser extent payroll. So let's go on and start off with the internal controls over plant, property, and equipment. Now, again, as I start off, this is the start off control that is in each of our transaction cycles, and it's regarding segregation of duties, and it's the same box in the same explanations. Okay, the functions of individuals should be adequately separated to ensure each function performs an independent check on the accuracy and the authenticity of the other functions in processing all of the transactions within that transaction cycle. And if you'll remember to the surgeon tapes, they talk about the segregation of duties in a transaction cycle, and Liz uses the mnemonic CAR, C-A-R. What I've done is I still use CAR, but I now spell it C-A-R-R because I've taken record keeping and split it up between record keeping and reconciliations. Whatever works for you works for you. But the mnemonic would be C, custody, A, authorization, R, record keeping, and R, reconciliations. And just like every other transaction cycle, if we find that the functions cannot be adequately separated, management has to step in and provide some form of sufficient detail review to make sure that the transactions were processed through that transaction cycle were properly authorized, properly executed, and the transactions were properly recorded within the financial accounting framework, and they reflect management's financial statement assertions. So let's go on to some of those independent functions here. Okay, first of all, record keeping, detailed property records, and the general ledger plant, property, and equipment accounts, okay, should be maintained by separate individuals. In other words, the record flow into the detailed property record and the general ledger account should be recorded by separate individuals to make sure that and then those accounts should be reconciled on a monthly basis to make sure that there's not been a mistake in either account. Also, property records should serve as an accounting control over physical assets and should be maintained by employees who are independent of those who are responsible for the custody of those physical assets. Obviously, if somebody has custody over an asset and also the detailed property records, they could take the asset and make that detailed property record basically, or adjust it, make that asset disappear off of the property records. When physical inventories are periodically taken to verify the existence of our physical assets to the detailed property records. In other words, go out there and actually locate those physical assets and trace them back to the property records. Okay, such inventories should be taken and reconciled to the detailed property records independently, again, with those charged with the custody of assets. Periodic reconciliation of detailed property records and the general ledger control account by an individual who is independent of maintaining the detailed property records. There should be a formal budgeting process for plant, property, and equipment with any subsequent variance analysis and that helps detect repair and maintenance type of items that were recorded as capital expenditures or vice versa. Okay, there should be a written authorization for the acquisition and disposition of capital assets. The same individual should not be in a position to both approve asset dispositions and asset acquisitions. Lastly, access to physical assets is limited to authorized individuals. So let's take a look at an internal control question for property, plant, and equipment. Okay, plant, property, and equipment transactions that may be misclassified as repair and maintenance expense would most likely be detected by. So again, choose your correct answer. As you're doing that, stop the video, and when you're ready to review your answer, go ahead and restart the video. Okay, the answer to number 1, plant, property, and equipment transactions that may be misclassified as repair and maintenance expense would most likely be detected by, and the answer is C, investigations of variances from the formal budgeting system. And again, as I mentioned in the previous slide, I said there should be a formal budgeting process with subsequent variance analysis, which helps detect repair and maintenance items recorded as capital expenditures or vice versa. Okay, let's go on now and take a look again at high-level review of inventory controls. At the very top again, I talk about the segregation of duties, and again I mention CAR, custody, authorization, record keeping, reconciliations. I also talk about the fact that these items cannot be, these functions cannot be adequately segregated. Management must step in and provide sufficient detailed reviews to make sure transactions that went through the system were properly authorized, executed, and they were recorded to reflect management's financial statement assertions within the financial reporting framework. Now let's go over some of the individual items here. The inventory custodian is prohibited from access to the inventory records, and that should be obvious because if the person who's in charge of access to the inventory has access to the inventory records, they can take items and adjust the inventory records, so it's like the item was never there. Maintenance of inventory records and general ledger records are segregated. Again, they provide a check on each other, the recording of the detailed inventory versus the recording of the financial information. Lastly, or I shouldn't say lastly, but physical inventory counts, or they could be called cycle counts, are conducted and reconciled and adjusted to the detailed property records by someone who is independent of the inventory custody function. Detailed property records are reconciled to the general ledger inventory account by an individual independent of the detailed inventory records and of custody. Detailed inventory records are maintained to ensure inventory can be identified as to location, quantity, and serial number, or sometimes cost if that's applicable in their particular costing system. In some cases, I've seen people when they actually go out and perform physical inventories, because the inventory is not detailed enough as to location and so forth, they end up counting the same inventory twice, or in some cases they miss the inventory totally. Okay, lastly then, access to inventory is limited to only those authorized individuals. So let's try an internal control question on inventory. Which of the following activities would most likely assist to maintain accurate inventory records? And again, you're given 4 choices. Go ahead, stop your video, and when you're ready, restart the video and view the answer for question 1 for inventory. Okay, number 1. Which of the following activities would likely assist to maintain accurate inventory records? And the answer in this case is D. Periodic inventory counts are used to adjust perpetual inventory records. Now, if we look at these items individually, okay, the first one is A. Perpetual inventory records are periodically compared with the current cost of individual inventory items. Well, in this case, it does show that the perpetual records agree to the inventory control accounts in terms of cost, but it does not actually confirm the actual quantity of inventory. KB, A just-in-time inventory or JIT inventory ordering system keeps inventory levels to a desired minimum. And that's what a JIT system does. But when you think about it, it does not confirm the actual quantity of the inventory. As an example, my just-in-time inventory system may show a quantity of 20 and I only have 6 items in my inventory. So in that case, basically, yeah, the system would say 20, but there's only 6 out there. Okay, item number C, requisitions, receiving reports, and purchase orders are independently matched before payment is approved. And what that does is that does support the accuracy of our accounts payable function for inventory, but does not support the actual physical inventory, the quantity, the accuracy of the inventory records themselves. D, periodic inventory accounts are used to adjust perpetual inventory records. And this is a correct answer, and it's physical verification of inventory, the quantity of inventory, to the perpetual inventory records. In other words, the quantity of inventories in our perpetual records improves the accuracy of inventory. And what that means is when I take a physical inventory and I count 20 items, I can verify that against the fact that I have 20 items in my inventory records, or if I don't, I'm going to have to adjust my inventory records to reflect the physical inventory. Now it goes on also to say that cycle counting physical inventory is usually even better. And what that is saying is that traditionally a manufacturing or even a merchandising company will literally take an entire physical inventory of their store, and when they do that, or their plant, and when they do that, many times they'll shut down their operations for a day or two and perform an entire physical inventory, and they typically do this on an annual basis. So the one thing you can say about an inventory is the inventory is accurate the date the inventory is taken. We take the inventory, and let's say that we have 12 items on hand, and our inventory records said there were 15. We would adjust our inventory records from 15 down to 12 to reflect the physical inventory. Now it's accurate. Now the day after that and all the days after that, there could be inaccuracies introduced into the system. So the further we get away from the physical inventory, theoretically, the less we can rely upon the accuracy that was generated off of that physical count. Now, in the case of what we call cycle counting, what happens is inventory is separated into different categories based upon characteristics that have been established by management. As an example, a management may create a inventory system called ABC cycle count. And what happens is that different inventory items are classified as A, B, or C. And A inventory items may be some of the highest cost items because the company wants to keep track of those, or they could also be items that are essential to production that we really have to be pretty accurate on those. B then would be those items that are kind of like they're moderate, but they're not as important as A's. And then C would be what would be remaining after that. Now you could have as many categories as you want, but what you would do with the A category is probably count that on a fairly frequent basis. Let's say you would count the A items once every, let's say, 6 months, or once every month or whatever, to ensure that there is a physical inventory taken of those A items at least on a relatively frequent basis, to make sure that those are as accurate as economically possible. We then take the B classifications of inventory, and they would be counted at a different frequency, probably a lower frequency than A, and then C would be the remaining items, and they may be counted perhaps once a year, maybe twice a year. So that's how many companies now that are working with manufacturing systems that rely pretty much on automated inventory records for ordering and for production and so forth, they perform typically ABC type accounts to make sure their inventory systems are as accurate as possible. Okay, let's go on now to our last subject area, and it's investments, controls over investments. Again, at the top, the functions of individuals should be adequately separated to ensure each function performs an independent check on the accuracy and authenticity of other functions in processing all transactions. And we go back to CAR, custody, authorization, record keeping, and my breakout, reconciliations. Okay, let's go down now to some of the other highlights here. Individuals who are independent of the detailed investment records, in other words, the records that actually have the physical investments recorded on them, should basically make the final entries to the general ledger. In other words, we separate the detailed investment records from general ledger maintenance. Okay, investment records should serve as an accounting control over our actual investments and should be maintained by employees independent of those responsible for investments. In other words, the people who are responsible for buying and selling those transactions should not be the detailed records that represent those investments, and the company should not be controlled by those people who buy and sell the investments. There should be, just like a periodic inventory of inventory, there should be a periodic confirmation of investments, and that should be performed by those, ideally two people, who are independent of employees with custodial or record keeping responsibilities. Ideally, securities should be maintained in an independent trust, and the trust is periodically reconciled to the general ledger accounts, accounting for investments by an employee with no access to trust transactions. What that means is, most of the times, as a matter of fact, in my long career, I know of only, well, before I go on and talk about that, what that means is most companies don't want to handle their own marketable securities, their stocks and their bonds. They give that task over to a broker who will then keep the stocks and bonds for the company. And if you own any securities or your parents own securities, most of I would assume the majority of your parents or yourself do not have the physical securities. They're kept on trust with the stockbrokers such as E-Trade or Merrill Lynch, companies like that. So you don't have to deal with them. And most companies basically do maintain an independent trust or a broker who holds the securities. As I was going to mention, with all the clients I've dealt with, there's only one client where they actually held on to their own physical securities, and the rest basically kept their securities in a trust. Investments should be authorized by the board of directors or a delegate. And what that means is the board of directors has to set the tone at the top about what type of investments the CFO or the CEO or the company itself can make, because the board of directors are representing the stockholders, and the board of directors will set the level of risk that they feel comfortable with in terms of if the company's going to invest in a stock or bond. Obviously, that is an investment and there's some risk associated with that. And there are very risky bonds or stocks, and there's also very relatively safe bonds or stocks in terms of market fluctuations. And the board of directors will set basically their tolerance for risk, and that policy then will be carried out by the CEO, CFO of the company. Also, physical safeguards over assets. Basically, let's assume that the company keeps the marketable securities on their own. In other words, they're going to keep it in a safe, or more likely, they're going to keep it in a safe deposit box at a bank. Okay, if it's a bank or a safe, or in effect a safe deposit, if it's a bank, which would be a safe deposit box or a safe on site, it should require two authorized individuals to gain access to it. So if you're at a safe, you should have a person, when they open the safe, somebody else should always be present. If you're dealing with a safe deposit box, there should be banking instructions for that safe deposit box that says the only time an individual can open it is in the presence of two authorized signatory. Also, when we're accessing stocks and bonds, securities in a trust account, typically, again, the transaction should require two or more authorized signatories. Lastly, periodic reconciliations of our investment subsidiary records and the general ledger account should be performed by someone not involved in the custody of the investments. So let's go through several questions regarding investments and internal controls, and that'll be the end of the video for today or tonight. Number one, which of the following control activities would result in safeguard against the loss of trading securities? Again, you're given 4 choices. Go ahead and stop the video, examine your choices, and when you're ready, restart the video for the answer slide. Okay, number 1, which of the following control activities would result in safeguard against the loss of trading securities? In this case, the answer would be C, an independent trust company that maintains the securities and keeps the records of the company's securities. In other words, it's like a bank lockbox where instead of the company receiving checks, the bank receives the checks and processes those checks on behalf of the company. The independent trust company, which is typically either a bank or a broker, will maintain the securities on file, and the employees of the company have no access to those securities. Okay, let's try number 2. Number 2, which of the following controls would most likely be used to safeguard marketable securities when an independent trust agent is not employed? In other words, a company keeps its own securities. And again, you're given 4 choices. Go ahead and review your choices, stop the video, and when you're ready, restart the video. Okay, video number 2. Which of the following controls would most likely be used to safeguard marketable securities when an independent trust agent is not employed? And the answer in this case is two company officials have joint control of marketable securities, which should be kept in a bank safe deposit box. In other words, it shouldn't be kept at the company's location, it should be kept at the bank. And if we take a look, okay, a designated member of the board of directors verifies the securities in a bank's safe deposit box on an annual basis. Okay, verification on an annual basis is not really an optimal control over marketable securities. It's also preferable to have more than one individual verify the securities. B, and by the way, a lot can happen in a year. B, the internal auditor and controller independently trace all purchases and sales of marketable securities from the subsidiary ledgers to the general ledger. Okay, B is verification of occurrence. In other words, the transactions themselves do not basically provide verification of existence. Gee, it sounds like we're going back to management assertions there. C, the investment committee of the board of directors periodically reviews the investments decisions of the CFO. And this is why it's a good control over investment policy. As a matter of fact, it should be something the board does on an occasional basis, but it provides no control over the existence and the accuracy of the security. So the answer is D. 2 company officials verify independently and together the existence and the type and the number of the marketable securities on hand within the safe deposit box. And that'll be the end of our presentation.